This conference will now be recorded.
So let's review for a second adjusting entries, and we don't want to be overly concerned. The entries that we worked on for the first 3 weeks are the most important ones. Adjusting entries only occur one time, typically at the end of the year. In the adjusting entry, cash is never involved. An adjusting entry also always involves an income statement account and a balance sheet account. The difference with adjusting entries is that we do not know the amount, but the accounts involved never change. So if we were making an adjusting entry for supplies, it's always going to be a debit to supplies expense and a credit to supplies. That doesn't change. Okay, so that's the key with adjusting entries, is that the accounts don't change, but you got to get the amounts. If we're doing insurance, same thing. It's always going to be a debit to insurance expense and a credit to prepaid insurance. That's the AJE. You have to get the amount. When we record depreciation expense, same thing. When we get ready to do that AJE, it's always depreciation expense and accumulated depreciation. So, hopefully that can help you. That is, if it's depreciation, that's the entry. If it's prepaid insurance, that's the entry. If it's supplies, that's the entry. So just make a note of that the entries, the accounts involved in the entries don't change. For unearned income, it's always a debit to unearned revenues and a credit to sales for the AJE. Now we have the preceding entry, but this is always the AJE. So when you get ready to make the AJE, it does not change. And and the same thing for the others. If we're accruing expense such as interest, that's always the AJE. Most times we're accruing salaries. So whenever it says accrued salaries payable, accrued wages payable, typically I'm going to give you the dollar amount. This is the AJE. So the AJE does not change. So you should, you've got this document, and so you should go back and highlight as I have, so okay, this is the AJE. Okay, this is the AJE that I got to make when I'm dealing with this item. Okay, so like I say, the adjusting journal entries only occur once a year. The regular journal entries are much more frequent and they're more important. So I don't want you to just be overly concerned about adjusting entry. They're different. You got to think a different way. But you do have, you do know what those entries are. So just go back and look at what those entries should be. And probably, we'll have a quiz, and I'll probably have some multiple choice questions for you on the quiz. Moving on to the cash, receivables, and internal control. So we're moving on now to the cash cycle. And note the cycle. We start a company by putting cash in the bank. We purchase supplies and inventory. We set up an accounts payable. The inventory is sold. It might be cash or receivable. We collect on the inventory and pay our expenses. And hopefully we're returning into the bank more than what we started with. So you start off by putting money in the bank. Then you buy inventory or perform services and buy supplies. You sell, you collect your receivables and get your cash. You pay your expenses, and hopefully an extra amount is left over so that your bank account increases. So that's the key, with the companies like for you personally, you are doing better if your cash goes up. Now, keeping track of cash is important. I talked to a regional bank manager, and he says every month they fire a teller. Every month. Several years ago, they probably firing more than that now. Why? Because controls are in place, and of course we have cameras and everything now and checks. But whenever you're dealing with cash, you have special controls in place, or it will walk. And so a lot of times what we're going to do is we're going to have a sales and cash receipts journal, and we're going to have a daily cash sheet. And the person on the cash register got to turn in cash equal to what the cash register tape said the cash was. So a daily cash sheet is done. So when cutting, restaurants, etc., when then a lot of cash transactions, they have to be really on top of it. Then the cash disbursements, a lot of time we just have a separate cash disbursements journal, and we still post them and everything, but we put whenever we pay a check, we put it there. So whenever we're paying something, we just record it in this journal. And we credit in cash, but we send the checks and we keeping track of our checks. And when you run a company, you got to keep track of those checks, check by check, to make sure no unauthorized checks are paid. So sales and cash receipts are in the cash receipts journal, sales and cash receipts journal. All cash payments in the disbursement journal. And the general journal that we've been working with, that's where all the non-cash transactions go. Anything other than these top transactions go into a general journal. As a business, they have to reconcile their bank account. They got a lot of transactions. Banks make errors, so they have to reconcile their bank account. And then, so that they don't write a check for everything, they set up petty cash funds. Now, once cash used to be in a petty cash fund and it looked like this. Now, most times a company has a debit card to handle small postage transactions, coffee for the staff, or things like that. You choose a debit card, and one person is authorized to make these expenditures on the debit card. So it is important to have internal controls in place when you're running a company. Everybody has to have internal controls. And the internal control process consists of a controlled environment, control activities, information communication, monitoring, and risk assessment. So this is a process of internal control, national standards set on when you're running a company and you got branches all over the world, you got to have some controls in place to ensure that cash and everything else is made in the correct way. So a lot of time we'll have internal auditors who go out and check what's happening at the branch locations. We had a lot of problems with fraud activities in the early 2000s. And so Sarbanes-Oxley Act was passed. And basically what this act does is that it requires the president and CEO to certify the chief financial officer that the financial statements are correct. When they're certified, then they can be put in jail easier. So one of the big things of that act is that, that things they wanted to happen, but a president and the chief financial officer must now sign that the statements are correct under penalties of perjury and jail time. So when you become president and chief financial officer of your big company, remember you got to sign that these statements are correct. So maybe that's why you need to be learning this accounting. Because if the chief financial officer makes a mistake, the president's still on, he's still responsible. So he has to know what's supposed to be in the statements. In summary, internal control of procedures and processes utilized by a company. First of all, safeguard its assets, process all these transactions accurately, ensure compliance with laws and regulations. Think about a Walmart or a Sam's. They got to do this all over the world. McDonald's also. The elements of internal control environment, assessing risk. You got to have procedures, monitoring, and information communication. And so you've got to have written procedures in place. And a big thing now is training employees. So at Texas Southern, we have to have customer service training. We have to do ethics training. We have to do sexual harassment training. So every year, all employees have to complete that training. So that's part of the process of making sure that appropriate procedures are in place. So every year, every employee has to complete this training. We're tested on it, and those test results are sent in. If you don't pass it, you got to take the course over. Control also, has to be the philosophy of the company that you're working with. That's key. Does your company try to do things correct? And does it have good personnel policies? Then there's some control procedures. You need competent personnel. You don't ever want to hire dumb people. You want competent, smart people. But you want to rotate. You want to separate responsibility. You don't want a person collecting cash and putting that cash in the bank. So somebody collects the cash and somebody else puts it in the bank. You're always separating the custody of the assets and accounting. So especially with inventory, you got those in terms of how much is purchased and went in the warehouse. You got a separate set of records going to the accounting department. And you need proofs and security measures. And a big part of that now is cameras. They're watching everything. If you're managing a company, if you're working for a company, there are some warning signs of internal control problems. if a person's lifestyle changes abruptly, if he begins to develop close relationships with the suppliers so he can get kickback, he refuses to take a vacation, he borrows from other employees, excessive use of alcohol and drugs, missing documents, missing check numbers, unusual increase in customer refunds. And what happens here, and a former student told me how she got trapped here. She was working in sales. They got a commission on everything they sold. So she would have friends come in and buy stuff. She'd get a commission on the sale. Then they come in and return it in a week or two. And so eventually that was caught. And so she lost her job. And so that she wouldn't have to go to jail, she had to pay all of those commissions back. So be very careful when you're working and be ethical. Because remember, they've seen it all before, and they got control and procedures in place to check things. So always be moral and ethical in the work environment. Other people doing it does not mean that you should do it. Okay. Bank reconciliation. Let's see if we can do a bank reconciliation today. Sometimes there's going to be a difference between what the bank statement says is your company's balance and what your cash book says, your T account for cash. And so a reconciliation has to be done. And we do two things. We do a bank analysis where we reconcile the bank statement balance to the correct balance. And then we do a company analysis where we reconcile from the cash balance that's in the T account to what the correct balance should be. So let's look at the components of the bank reconciliation. So for a bank, there's, when you're reconciling that bank statement that comes to you, you're going to add deposits and transits that the bank doesn't have. You're going to subtract outstanding checks that have not been paid by the bank yet to come up with the correct balance. So if you're running a company, that's what you do. Then when you're doing your company analysis, you're going to enter the cash amount from the ledger. You add credits that have not been recorded by you, but have been recorded by the bank, such as the bank paying you interest, so you didn't have that, so you make the journal entry for it. And you deduct debit memo for service fees and customer checks not paid. So we're doing two reconciliations to get to the correct balance. So our goal is always to get to the correct balance. Our goal is always to get to the correct cash balance. So let's look at an example of this. And a former student wrote this problem. Sebastian Stevenson operates a successful business and banks with Chase. On April 30th at 12 noon, his bank balances was $20,000 at Chase, and the balance in his T account was $20,000. Then at 1 o'clock, things began to happen. The bank added $500 because we're on April 30th, end of the month, for interest. Got a lot of money in the bank. They paid them interest, and they deducted $100 for service fees. So once they added the $500 for the interest, and they deducted the service charge, they had this balance at $20,400. $20,000 plus the $500 interest minus the $100 service charge. Sebastian then was busy himself after 12 o'clock. He made a deposit online for $3,000, which the bank doesn't have. He made a cash withdrawal of $500 for weekend expenses, and he wrote a check for his rent for May and gave that to his landlord. So he gave that check. So once he put the deposit in for $3,000, and then he took out the cash of $500 and wrote a check for his rent. His $20,000 in his bank went up by 3, but down by 2, so he's at $21,000. So the question becomes, what is Sebastian's correct balance? How much money does Sebastian actually have based on what the bank did and what he did? Do you all know how much money Sebastian had? The real amount. Okay. So let's see if we can get to the correct cash balance. And we did a company analysis first. So remember, after going from 20,000 to depositing 3, withdrawing 500, writing a check for 1,500, the checkbook and the T account showed 21,000. Okay, so what Sebastian has to do is for the company now, he got to go up here and look at what the bank did. And the bank gave him $500. He didn't have that. So he's going to add that unrecorded deposit 500. That gets him to 21,500. He doesn't have the bank service charge of 100. So he's going to subtract that. And when he does that, 21,500 minus the 100, he comes up with the correct cash balance of 21,400. He comes up with a correct cash balance of 21,400. So that is his company analysis. Let's look at the bank analysis. So when the bank gets ready to do its analysis, so the bank's not doing it, but we're reconciling the bank statement. The bank showed 20,400. It showed 20,400 on the bank statement. So what the bank has to do, what we do on that bank analysis, the bank didn't have this deposit in transit of 3,000. So we're going to add that 3,000. That gets us to 23,400. The bank did not have the rent check that we wrote, the cash that we took out. All that happened after 12 o'clock. That was 2,000. So when we have the 23,400 and we subtract the 2,000, our correct balance is 21,400. So you can see that we're coming to a correct balance each time of the same amount. So when we're running a company, we don't just depend on the bank. So you may just depend on the bank to give you your balance now. But if you're running a company with a lot of transaction, you're going to do a company analysis, then you're going to do a bank analysis. You're going to do a company analysis, and you're going to do a bank analysis. So let's just see if we can come in here and practice a little bit. So this is not the hardest thing in the world. Okay, so let's see if we can practice doing a bank analysis. And then I guess we need a company analysis also. So we need the correct balance here. So we're trying to get to the correct balance. Bank analysis, then we have the company analysis. Okay, so here are the situations. The balance per the bank was $20,000. The balance per the books was $19,500. Outstanding checks for $4,000. That is, these are checks that were written that the bank didn't have. Deposits in transits were $5,000. Interest income credited was $2,000. Service charge is $500. So if I gave, so in this A situation, if I gave you that information, what is the correct balance? Can anybody tell me what the correct, in this A situation, what is the correct balance? Does anybody know how much money they have? The correct amount. All right, I'm gonna work this in for you. It says we're doing the bank analysis first, so the balance per the bank was $20,000. Then the deposits in transit, $5,000. So we bring those up here. Then the outstanding checks were $4,000. So we just sort of putting these in our analysis. So our correct balance would be what? 21,000. Now let's look at the company analysis. The balance per the books was 19,500. That comes here. We don't have the interest income, so the interest income credited by the bank was 2,000. So we're going to add that 2,000. Then we're going to subtract the service charge, and that's a miscellaneous expense. So this is a plus. And this is a minus. So if we do that, what amount do we come up with as the correct balance on the company analysis?
21,000.
Thank you. All right, y'all go ahead and give y'all 5 minutes to finish out this chart. For B and for C. So this is not the hardest thing to do. So give me the correct answer in the B scenario and the correct answer in the C scenario. Or we'll just do B, I'll let you do C at home. So you all are working to get me the correct balance in the B situation. Y'all got a correct balance yet for B?
Working on it.
Okay. Continue working.
Is there like a scenario for B, or are we supposed to look at A to get B? I'm confused.
You kind of you're putting the numbers the same place that we did in the A.
Right, okay.
I think I'm ready if you are.
You ready, David?
Yes, sir.
Sounds good to me. So what's the balance per bank?
25,000.
What's our deposit in transit?
3,000.
What's our outstanding checks?
5,000.
So what's our correct balance?
23,000.
Okay. See how he did that? Then what about for the company analysis?
22,500.
Balance per the bank,
1,000.
1,000 for the interest.
500 for
500.
expense.
So what's our correct balance?
23,000.
Okay. So this is the kind of analysis that you make. So I'll leave you all for C as homework. So you'll be ready to work that on the quiz.
Where is he getting the numbers from?
At the bottom, let's say bank reconciliation and practice problems. You just have
Mm-hmm.
to plug them in to like where it says like balance for bank. That's 25,000. Then what's that outstanding checks? You just go down from B. You'll see where it say 5,000. You plug it up there up top.
So
Oh, it's above the charts.
below the chart,
Below.
Okay, where is this at in our on Blackboard?
it's in the primer.
Okay.
Maybe I'll put this in there. We'll see. Okay, so when you do C, you're just gonna go over here and put these things in for C. So that is not one of the easiest things y'all had to do.
So C would be
Well, no, work on that and we'll go with tomorrow.
okay.
Work C and we'll go over that tomorrow. And for our A students, here's a big comprehensive problem for them. And I want them to get bored with something so simple. Okay. We are now ready to work on our last financial statement, the cash flow statement. We're ready to work on our last cash flow statement. When you graduate from college, your parents and significant others would be very happy if you got a job with a salary where you could buy some more assets, pay off some student loans, and have money left over. That would be a good situation. So this cash flow statement that we found statement looks at that from the business standpoint. And it works to have us look at what our cash prospects, what's the cash, where did it come from, and were we able to expand, and were we able to pay off debts. So that's where we're going. We'll take a break, and I'll see if I can find a handout to put this in Blackboard. So we're going to take a break. When we come back from the break, we're going to work on the cash flow statement.
This conference will now be recorded.
Okay, let's see if we can share the screen again. But this handout is now in course content, okay? So you should be able to find it in course content now. Okay, so we're into our last statement. We've done the income statement, statement of retained earnings and balance sheet. And now we're working with preparing the statement of cash flow. You can remember we start a company off by putting cash in it, and that cash is reflected in us receiving common stock. So we give the company the cash and we get common stock. And what is supposed to happen with this company is that the cash is supposed to go up by earnings, not by borrowing. So if this cash is not going up through earnings, then why did we invest in, why are we investing in this company? So whenever we're looking at a company, you want a retained earnings number that's positive, and ultimately you want the cash and other, the assets to increase, but especially cash at the end of the day. So always keep that in mind. There are 4 parts to the statement of cash flow: operations, investments, financing, and the last part is the change in cash flow. For a company, operations is like the salary that you have that we talked about. That's where the cash is supposed to come from. Investments in a good company is negative because you're expanding. So if we are Macy's, we want our cash to be coming from the sale of clothes. We want to be opening more stores, and so investments should be negative. Then we want to be paying off debt and still have cash left over. So so a typical example, if our company made $1 million, had $1 million in cash from operations, if it expanded and spent $400,000, if it paid $200,000 in debt and still have $400,000 left over, that's an example of a good company. Just like with you personally, if you have a salary of $100,000 and you buy some more assets for 40, you pay off some student loans for 20, you got 40 left over, you're doing pretty good. So we have to make that same analysis for a company. Now, we have a, I guess, prescribed way that we prepare the statement of cash flows, a mechanical way. We review all of our journal entries. So we're going back to journal entries. Any journal entry that is not 1 through 11, we scratch. And then we complete a cash flow template. So when we're preparing a statement of cash flow, journal entries 1 through 6 are always sources of cash. Journal entry 1 is a cash flow from financing. That's how we start the company. Journal entries 2, 3, and 4 operations, along with a short-term loan. Journal entry 6 is cash from the sale of long-term assets. Remember, we buy long-term assets to help us run our company. A company getting cash from sale of long-term assets is like you selling your car and going to Las Vegas. So if you were to sell your car and go to Las Vegas and blow all your money, when you came back, what's going to be your situation? Gonna be pretty good. Can't get to work, can't do this, can't do that. So if a company is selling its long-term assets, if Macy's starts to sell stores, they're not gonna have anywhere to generate these sales for cash and sales on account. And so we show that separately. And then if we borrow money long-term, that comes down here. So the current items and current assets are up here. So we're showing the source of cash 1 through 6. Then the uses of cash are 7 through 11. And we're showing where they go. And then we get to our net change from how much from operations, how much from investments, and how much from financing. So this is a key template that you utilize as we move to prepare this cash flow statement. So let's look at an example of how we prepare a cash flow statement. And we have 14 transactions. Okay, we have 14 transactions, and we want to prepare a statement of cash flow. So we want to prepare a statement of cash flow with these 14 transactions. Okay. So the first thing that we do is we look at the transaction type. Contributed cash of $200 to begin the business. That is a type 1. Wish I had these box here. So that's a type 1. We're going to keep this and put this on the statement of cash flow. Then when we have the inventory and we buy it on account, that is a type 12. So because it's not 1 through 11, we're going to scratch this transaction. It's not going to go on our statement of cash flow. We had cash sales with 1,200 with cost of sales 600. So this is a type 2 for that first part. So we're going to keep this. But when we sell an asset and transfer costs, I think that's going to be something like a type 13 or something. So we're not going to use this part of the transaction on the statement of cash flow. We're going to scratch it. I forgot what type that is. Sales on account, 1,800 with cost of sales, 400. So this is a type 15. So it's not 1 through 11. So we scratch it. So on our statement of cash flow, I only got going to be journal entries that are included in 1 through 11. Purchase of supplies paying cash. This is a type 7. We're going to use it. Pay salaries of $200. This is a type 9. We're going to keep it. Purchase equipment costing 600, paying cash for 200, and signing a long-term note for the balance. So when we buy the asset, when we pay the $200 down, that's going to be a type 7. That's buying an asset using cash. And when we pay the other 400, we're going to treat this as a type 5. And we'll see how that works in a few minutes where we borrowed cash. So we'll come back and then we put it in, but we don't scratch that one. Collection of accounts receivable, that's a type 3. We're going to put it on the statement. Paid on long-term note, 200. That's a type 8. Paid dividends of 200. That's a type 10. Supplies on hand at the end of the year. That's going to be what? I think that is type what? Type 13 or whatever. But it's not within 1 through 11. It's an adjusting entry, which doesn't involve cash. And so we scratch it. Depreciation expense. That's a type 14. We scratch it. So equipment costing $250 for $600, that's a type 6. And so we keep that. Now we don't, what we sold it, the costing part, we aren't concerned with that. We're simply concerned with the cash that we got. Okay. So our first step in preparing the statement of cash flow is to scratch out all journal entries that did not involve either the inflow of cash or the outflow of cash. It has to be a source of cash 1 through 6, or a use of cash 7 through 11 to go on the cash flow statement. Anything else, we scratch out. So now we're ready to do our statement of cash flow. And I'll take these out. Okay, so this is the template that we're using, and we show source of cash and use of cash. If it's a source of cash, if it's a 1 through 6, it's going to be in the source part, and if it's a 7 through 11, it's going to be a use part. So we'll see how this operates in just a second. Now, journal entry number is just that number here. Okay. Then journal entry type comes here. Okay. So journal entry number is here. So we keep track of them. So what we do, contributed cash. That's a type 1. Type 1 go into part 3 as a source. So for the first one, that is going to be a type 1. And we got cash. We started the company with $200 in cash. We skip 2, then we go to 3. Cash sales were $1,200. So cash sales, that's a type 3. Journal entry type 3 are sourced in part 1. So we're going to take the 1,200. We're going to put it right here. And so this is transaction number 3 with the journal entry type. Journal entry type is a 2. We go back up again to the next transaction, sales on account. We skip that. That doesn't come on there. Come to 5, purchase of supplies paying cash of 100. That's a type 7. Where does type 7 go? Type 7 is a use in operations, which is what we're supposed to be about. So you're going to see these current assets and current liabilities are in operations. So that's going to be a type 7 where we purchase the supplies. So that's going to be a type 7. And the supplies purchase was 100. So once again, if it's a 1 through 6, it's on the source side. 7 through 11 is on the use. Let's go on to transaction 6, paid salaries of 200. That's a type 9. Type 9 is an operating item. So so we have a type 9. And the amount is $200. So we're going through each transaction, determining if it is 1 through 6 for a source, 7 through 11 for a use, and we're determining whether it's in operations, which is the main activities of the company. This is how the company generates its salary. It buys items and it sells them. Pays expenses, and that's type 9. That's number 6. Our next transaction, we purchase equipment, and we like our companies to do this, to buy equipment and expand. Now watch how we're going to do this. We buy an asset, but we want to know what the total cost of the asset is. And so we're going to put the total cost down here. Because it's important to know what the total cost is. So this is a type 7. Then we're going to say that we pay 200 directly, but then we borrowed 400 in a type 5 and paid the rest of this. So with 7 is in 2 locations. And of course, we borrowed the difference between the note 600 and what we paid in cash 400. So the reason that we treat this way is, number one, yeah, we paid cash of 200, but the asset cost 600. That's more useful information. Then it's also useful to know that you got to pay back the 400. So we still net the 200, but we're going to put the full cost of 600 in terms of what the item costs. And then we're going to show the difference between the down payment of the type 5 where we borrowed money. Okay, then number transaction 8, paid on accounts payable 700. Type 8. Where does type 8 go? In part 1. So it happens to be transaction 8. It is a type 8. And we said we paid what's $700. So we're recording our cash transaction. So in essence, we're just recording whatever we debited or credited cash for. Then we collected on accounts receivable 500. That's the type 3. Where the type 3s go? In part 1, because that's operation. So when we collect the 500, that's transaction 9. We're going to have 500 here. Transaction 10, paid on long-term note 200. That's a type A, but since it's a long-term, it's going to be in part 3. So it's a type A, but it's a long-term liability. So it goes in part 3. That's 200, number 10. So with transaction 10, it's $200. It's type A. Then we pay dividends. So that was transaction 11, 100. It's a type 10. Where the type 10s go? They go in part 3 as a use. So for transaction 11, we're going to get the 100. And then for 12 and 13, we scratch them because they're not 9, 1 through 11, so we don't use them. Then we're going to come to the equipment, where we sell the equipment that costs $250 for 100. That's a type 6. And see, we don't like to see ourselves selling. We'd rather be investing here, but in this case, they sold some equipment. So this is not operation. We're in the selling our inventory. So when we sell a long-term asset, it comes in part 2. So we know that's not operations. So that's going to be a type 6. And the amount of cash that we got was 100. So with a Macy's, we don't mind type 2s and 3s, sales of cash, collection of accounts receivable. That's what they're supposed to be doing. They're not supposed to be selling their assets. As I told you, this is equivalent to you selling your car and going to Las Vegas. So we rather see negatives over here because you expanded rather than you selling your assets. So let's look at what we did. We have 14 transactions. We scratched the transactions that were not 1 through 11. And then based on this chart, we put the transactions in the appropriate box. Now we're going to add up everything in part 1. 1,200 and 500. So we add those up. That's 1,700. So our sources in part 1 was 700. Our uses were what? 7, 3, 100, 1,000. And so from part 1, we got 700. In part 2, our sources were 100. Our uses were 600. And so this becomes a minus 500, which is, okay, we don't we want to be buying more assets. Just like you, when you graduate and you got a job, you want to buy assets, not sell them. Then we go to part 3. Our sources are 600. Our uses are 300. So this becomes a positive 300. So now we add part 1 plus 700. Part 2 minus 500. It's down to 2. Part 3 plus 300. So our change in cash flow is 500. So what we're doing is we're looking at how much cash came from operations, how much went out for investments, hope it is negative, and how much cash came from financing. That is, we put this money in the business. The business is supposed to be putting cash up here. So we put our money in the business and we borrowed money. So there'll be a lot of money in operation. That's the purpose of it, because this is representing earnings. And so we want the receipts, the earnings, to exceed the current expenses. So that's how we do a statement of cash flow. That's how we do a statement of cash flow. We determine transaction types. We scratch those that are not 1 through 11. And using this chart, we put them on this template. And then we determine what our sources and uses of cash flow. Okay, we have problem 4-1, and I want you to begin work on problem 4-1. And the first thing I want you to do on 4-1 is put in your journal entry types and determine what you're going to scratch. So you want to go to 4-1, put in your journal entry types. So you should have this, you should have this item. So go and put your journal entry types down. Put your journal entry types down and determine what you're going to scratch. So that's what I want you to do. So this is problem 4-1. Put your journal entry types down and do your scratching. So let's take about 15 minutes. I'll give you 15 minutes to do that.